All right, guys. Last session of the day. I think it's proper networking time, but luckily we still have a lot of viewers on the live stream. So thank you guys for sticking with us for what I think is one of the most interesting panels of today. So really excited to have our panelists here with us today. Let's just start with a quick round of introductions before we get started. Maybe start on this side because Sal doesn't have a microphone yet. We're going to have to share.
Okay. All right. Hi, everyone. My name's Ray. I'm with 7X Ventures. So basically, we're a 100 million crypto fund, and we invest in a lot of projects, including Monad, L.net. And I'll say our investment thesis is around like AI infrastructure and also DeFi, etc. So pretty broad. And DePIN and AIs has been like one of our key focus as well.
Hey guys, I'm Ed Roman. I'm one of the co-founders of HackVC. We're a $500 million kind of AUM venture firm focused on early stage crypto, mostly on infrastructure, so DeFi, Web3 infrastructure, crypto AI, etc. We're a lead investor, so we typically are thesis driven. And my background is I was a serial entrepreneur before I became an investor. Ran 3 startups as a CEO, had a couple of exits, and now I'm just here to help founders, basically. So that's about me.
Hey everyone, thanks for coming. My name is Sal Gallo. I'm one of the co-founders of EV3 Ventures. We have been investing behind DePIN and other categories for the past 2.5 years, and we basically think of ourselves as a firm that helps to expand the aperture of the crypto economy. And what that means for us is we're always willing to squint a little bit harder than other investors as to what DePIN and crypto can enable.
Awesome. So the title of today's event is DePIN Loves AI. So my first question is very simple. Why do you love DePIN and AI? And what are your investment theses in both of these categories?
I wouldn't say I love DePIN and AI. Like the more you love it, the more you criticize and like think about it, right? So like DePIN and AI definitely like huge topics, but the thing I like think about like more is about like why it hasn't like take off that much and what we're lacking right now. So for DePIN, you see a lot of like really good projects with beautiful like user numbers, but sometimes the tokenomic just fell short because maybe the buying pressure from the like revenue doesn't necessarily create a like meaningful buying pressure for the market cap. And also there's a lot of like disconnecting part with DePIN, but definitely this is one of the most like fast growing part. And also in terms of AI, I think we've been investing in a lot of founders. They've been like starting from AI and leveraging whether it's decentralization or tokenomic to empower them. So yeah, I've been like thinking a lot, but like criticizing a lot as well.
That's a good answer. Yeah. Well, I think we should talk about DePIN and AI separately because we think about each of them separately at HackVC. So for DePIN, the reason why we're excited about DePIN is we think that DePIN uniquely gives the opportunity for founders to create new kinds of businesses that they could not actually create in Web 2. And what I mean by that, I'll give you an example. So you look at Helium, for example, which is a decentralized kind of wireless network. The way Helium works is there's a bunch of nodes around the world, and they're all kind of standing up little cell phone towers in people's rooftops. And linked together, they provide cellular access, 5G level cellular access, right? Just a new kind of subscription plan that you can get for this. So if someone were to try to build that business in Web 2, they'd have to convince a venture capitalist to give them an incredible amount of money to stand up cell phone towers all over the country. And you'd need enough cell phone towers to have coverage of the entire country, because your cell phone plan is actually useless unless you have coverage, right? So you have this critical mass problem where you need all this expensive hardware to create a useful network. But with crypto, right, you can kind of leverage your token supply and incentivize these people who are running nodes all over the country, temporarily subsidize their costs with your governance token, right? And therefore you can get to that critical mass of supply side, coverage to then make the network actually useful for customers. And then hopefully someday customers come and pay for that. And that's what's actually happening right now with Helium. So like the reason why I'm telling you this story is because it's a good example of how crypto helps you create a business that would not be achievable in Web 2 because the capital costs would be too expensive. So we look for startups like that, startups that can create new kinds of businesses uniquely with crypto on DePIN. Now, on the AI side, we have a little bit of a bias at HackVC. We kind of think that the crypto AI market that addresses crypto users is a relatively small market because the users within the crypto world are not that plentiful compared to Web 2. We think Web 2 AI is where the really large market is. McKinsey, I think, predicted somewhere between 18 and $23 trillion of GDP gains worldwide from AI. And that's going to be mostly Web 2, right? So we think the opportunity for Web 3 is to create these like interesting stacks in Web 3 that are maybe more cost effective by using underutilized compute cycles and GPUs, things like that, but whose customers come from Web 2. We think that Web 2 customers are the real market for Web 3 AI stacks. So that's kind of how we think about those two categories.
I agree with what Ray and Ed said. I think for the way we think about our EV3 is that DePIN can help create the ingredients that are necessary for artificial intelligence. What do you need to create AI? You need compute, you need energy to power it, you need bandwidth to get data from one place to another, you need the actual data, and you need some human input or like judgment as to like what are the actual helpful outputs or not. And we see DePINs disrupting each one of these categories and basically all combining the ingredients as to what comes out at the other end, which is artificial intelligence, and that's how we think about the combination of these two worlds.
I think you guys gave kind of different answers each. Like one was separate DePIN AI, one was kind of a little bit of a mix, and one was how DePIN contributes to AI. Just talking about the intersection specifically, there's been a lot of hype around DeFi and AI. I don't even know how you pronounce DEFAI, DeFi. And now Masari has put out a report. We just talked to Dylan, fireside chat earlier today. Also incredibly hard to pronounce. Decentralized physical AI, DePi. I think we got to quit it with the acronyms here soon enough. But what do you guys think decentralized physical AI means? And is this a category you guys are looking into? It's more of like a forward-looking narrative than anything that has, ARR numbers that you can, apply your own methodologies to. But what are your thoughts about the physical AI sector?
Okay, I'll start from the DFAI stuff. So like one thing about, so a lot of projects just for the sake of the hype, like I created AI agent ticker. But what I most excited about is if you really think about it, on-chain AI, one thing is agent themselves cannot own a bank account, but they can own their own like crypto wallet. And also your stable coin is actually act like a data API that can own by transact and managed by the agent. And also in between you have like multi-agent network then like facilitate, like inferencing, whatever. And I think this is the starting point of the DFAI stuff. And for the physical part, a lot of people was like, if we adding this part with robotic, we maybe have this automatically, operating system in the city. But I guess, that's a little bit further away. But first part, how to like tackle this like, multi-agent network and really make it work. Because the other problem is authentication. Whenever you allow, like, delegate your agent to conduct the transaction, whenever you log into an app, you have this OAuth and a lot of problems. And also how you tackle this reasoning, because you need real-time, like, fault, like finding and reasoning, and a lot of like difficulties in between. But like the idea is very exciting for sure.
Yeah, it's a great answer. Just to add to that, when we think about decentralized physical infrastructure, the idea that comes to mind first would be decentralized GPU networks. That's the obvious one, right? And there's a bunch of these. There's IO.net, there's Akash Network, Exabits, Ether is an example of this, right? There's probably a dozen or more of these that are kind of duking it out right now. And the whole hypothesis behind these is that you're bringing new economics to AI by taking advantage of compute cycles that will be underutilized. Like a good example of this would be, imagine you rent a GPU from Amazon for a year, like an H100 from Amazon. H100s are, they're kind of scarce. So Amazon can actually charge you for an entire year whether or not you use that GPU every day, you're still paying for it for an entire year. So what happens on those days you're not using it, right? So the whole idea is let's give those customers a little bit of a refund on what they're paying Amazon by allowing others to use those GPUs in those idle cycles. And that can also be applied to home networks as well. So gaming GPUs on desktops. Now there's a reliability concern that comes up on the desktops for games because, these are consumer devices using your home internet. So if there's a power outage or if someone wants to start playing games all of a sudden, then there's a reliability question around that machine. So what a lot of the GPU DePINs are doing right now is they're making those devices available kind of for hobbyist use of AI and for individual use, but they become almost like a lead generation for businesses who want to use more enterprise class GPUs that are more reliable. So that's kind of where that market is headed right now. There's another subcategory here that we haven't really talked about, which is kind of the intersection of decentralized finance and AI, right? Which is also kind of like DAI, right? It's kind of a misuse of the buzzword because DE could stand for DeFi, not just decentralized. And so the whole idea behind this is tokenizing GPUs. It's the idea that a GPU itself can be tokenized, and that token, which would be like an ERC20 tradable NFT style token, that token can be investable. So someone on chain can basically own a GPU by owning this token and also receive yield as that GPU is used for AI inference. So imagine creating like a revenue stream for yourself by owning a GPU on chain, and then imagine lending someone that in a DeFi pool, right? And rehypothecating that in interesting yield ways. So it's a new kind of financial asset that is based on physical infrastructure. So we think that's a really interesting primitive as well for all those investors out there in the world that they want to like kind of buy into AI on the public stock markets, but they're scared to invest in NVIDIA because maybe the stock price will go down. So this is kind of like a way for them to like buy into the economy of AI in their own unique way.
Yeah, just double down on the compute network. So one of the ways we think about AI is to actually make the analogy to natural or organic intelligence, and GPUs are like the brains of AI, right? And one of the most interesting pieces of data that I think crypto networks are uniquely attuned to is actually your eyes. Like if you're laying at night staring at the sky, like not moving, more than half of the energy that your brain and body is using is literally just like processing visual images in order to get an understanding of the space and the world around you. And we think AI is going to do the same thing. Like you can imagine being in like, I don't know, like the early 2000s and going to you're a human. You go to a website, you open up your like Netscape browser. You need a digital domain. Like you need an address to go to in order to contextualize where you live within this digital world. We think the inverse will also be true, meaning AIs are, when they want to come to the physical world, whether that's embodied in a drone or a robot or like an avatar, they're going to need a domain to understand the space around them, where they are in the context of the physical world. And we think that's going to happen with 3D maps. And so we spend a lot of time thinking about how do AI agents get a physical understanding of the world around them. That probably means getting cameras, which capture a shit ton of data, process over it, create a 3D map. And now you start to have spatial understanding of where you are. You can interact with other objects. You can, leave notes for other AIs or agents in that space. And so we take that analogy really seriously. It's like you have your brains, which is the GPUs and the compute. You have your eyes, which is the sensor and spatial awareness. You have like your part, which is like the power equivalent to power these chips. And I actually think like the relative importance of those will be the same for humans as it is for AI. And visual, like video data is one of the most powerful pieces. It's something we spend a lot of time thinking about.
Awesome. I mean, 3 really cool startup ideas here, agent swarms, real world agent swarms, kind of mimicking what's going on in the DeFi space, turning, GPUs into tokenized commodities and, geospatial crowdsourcing of geospatial information to train physical AIs. All of these are interesting kind of like narrative market fit ideas, which is important from like an investor perspective. But I want to talk to you guys about, or ask you guys about your investing approach these days. Like this time last year, a lot of seed checks being written. Now a lot of secondary market activity through liquid funds. There's also like each fund has their own approach, whether they're seeking like moonshot narrative market fit type of ideas, whether they're looking at user numbers, product market fit ideas, or they're just taking, on-chain ARR as kind of like the most important metric. So it's a very broad question. What is your investing approach right now, and how has it changed over the past year?
Yeah, I feel like for the past 2 years, one common mistake that VCs usually make is like narrative-driven investment. So whenever there's like sexy like narrative popping up, like modularity, staking, risk-taking, whatever, like we have like FOMO and the valuation's like huge. But when you really see them launch, right, like the liquid, like the market, like even the biggest like exchange, you see like the token went down like, all the way down. When there's no sufficient liquidity in the market, the VC and the project themselves turn into PvP, competing with exit liquidity, right? So I don't think this is like optimal scenario for like anyone. So right now, I think like we're kind of calm down and the market is like drilling down right now, and everybody in a relatively reasonable, like sense of investment in terms of one, the valuation and the stage of the project. And also like in terms of the user numbers, I don't think if you invest in early stage project, you can never like project, what's the user number or whatever. If you want, like the very like early stage seed phrase, etc. So one thing for us is like, how do we approach the real PMF, and does it make sense in the long run, and what problem are you tackling? This is very important. And also, like for early stage product, the founder experience and also their approach, because like crypto is too easy for founders to make money, right? But what we want is really to pushing this decentralization and tokenomic like way further than we can reaching the point that we can really affect the real world and the real AI trend. So this is a lot of like combining like thoughts, but in general, just like do our DD like really seriously.
So you made the comment earlier that there were a lot of seed checks in the past, right? We don't think that's going to change. And the reason why we don't think that's going to change is because how VC funds are raised. So VC funds, the capital that goes into a venture capital fund comes from these guys called limited partners, which are investors in the VC funds, basically. And these are like large institutions, they're individuals, family offices. And crypto as a category is still kind of like a 3-letter word at a lot of these institutions' decision-making meetings, meaning they don't like crypto because crypto sounds scary. It sounds like a security risk, right? It sounds like I might lose my job if I vote to invest in this venture fund as an LP. So that we hope will change. We hope that with the Trump administration, we think that the regulations may change, and that will maybe cause more confidence in the community. And then you'll see the crypto funds get bigger. The VCs will get bigger, right? And when they get bigger, they tend to write bigger checks. And that's where the Series A checks come from. That's where the Series B checks come from. So there's this weird dynamic in the market right now. We've got a ton of seed funds in crypto and very, very few Series A funds. So it's an unhealthy dynamic. I think actually it's not fair for founders, because founders don't have enough bargaining power, we think, at the Series A level as a result of that supply and demand mismatch. So if you're a credible founder with a strong vision, great team, right, good market opportunity, it's reasonable to raise a seed round in this market. It's challenging, we think, to raise a Series A round. And so we hope that'll change in the future.
I totally agree. The bar to raise a Series A is much, much higher, and probably the bar to raise a seed round in crypto is as low now as it has been in Web 2 venture, like forever. I don't think it's been easier at any point in time in Web 2 to raise a seed round than it is in crypto today. It's just the reality of the market. But again, like I was saying, it's this extremely, extremely steep hill to get to the Series A and B benchmarks. The one thing I'd say that doesn't change, that's constant, is just that no matter how much you over-intellectualize investing, there's always founders who just like move fucking mountains and get shit done, like to the point where you're not able to even like realize before that. And I think there's like CZ and Anatoly and Satoshi and Vitalik, and like there's only a couple of people that have managed to build $100 billion protocols in crypto. And really the job of the VC is like try to fine tune your mental model for how you can spot that before anybody else does. And that's kind of the unending thing. Obviously market structure changes a lot. VCs make money when rates go down. Like rates have not gone down the past 2 years. It's been a tough time from that perspective, but founders always find a way to overcome. So it's all about, in my opinion, that's the timeless, the everlasting consistent thing about venture.
All right. I had a couple more questions, but the number of people in this room has gone up faster than crypto has declined over the past week. So there's obviously some questions from the audience that maybe you guys want to ask. Any takers?
Sure. I mean, I think what Paul talked a lot even in this conference about, like, again, Web3 versus Web2. You mentioned Web2, not onboarding Web2, I think it was you, sorry. What is, the key to unlocking Web2 adoption, Web2 to Web3, in your point of view? And is it about crypto just being a back-end thing? Is it, all these things, DePi with AI and all that? That's just like buzzwords.
It's a great question. So to unlock the Web2 audience, we think that's necessary for crypto to gain mainstream adoption because the crypto market is too small as a user base. There's a few techniques that could help with that. One is making the user experience very simple for end users, hiding things like gas, right? Gas should be abstracted away. You shouldn't have to worry about gas or a wallet, right? Look at what Polymarket has done, right? Look at how simple the user experience is. It's a great example of how the right way to do things is. Another example is kind of progressive web applications on mobile, right? Very simple thing to download and to install, right? But beyond that, we think that you have to solve a problem that's worth solving in the Web 2 world. That's the key, right? So like the example we used earlier was GPU DePINs providing cheaper compute, right? Through underutilized compute cycles. That is creating new economics for AI, and the AI market is in Web 2, right? So if I approach a Web 2 enterprise that's doing a ton of AI, and let's say we approach like OpenAI, right? OpenAI spends 2/3 of their multi-billion-dollar budget every year on compute, and 1/3 on people, right? 2/3 on compute, right? That's just one example of a large Web 2 AI company, right? So the opportunity set that we think for crypto is to make those economics cheaper for customers in that category, and the sales cycle we're seeing is actually very short, because when you can offer a very comparable level of service with high availability, reliability, that's the key. It has to be the same level of service, right? But at cheaper prices, customers tend to say yes very, very quickly. So what we look for at HackVC are startups that create new economics for customers. We think that those startups tend to grow faster than other types of startups because you're solving a pants on fire problem.
Yeah, I think adding to that point, I think building something crypto related, like applications way harder than you build in Web 2, because not only you have this like user experience friction, like chain abstraction, construction, but also you have compliance like way harder. For example, if you want to build for example, Helium, they put like tons of money into like compliance and legal stuff. And also like, I work at TikTok before as a product manager. So like I always into like consumer side. When I seeing all the like applications from crypto, one question is you're not competing with crypto projects. You're competing with every single application that take people's attention. Like TikTok is not only competing with YouTube, it's also competing with like Twitter and any application that take your time and energy to consume, right? So the problem is not only you have this like technical like background, you have to solid the tech and also compliance force, and also you have to find the proper like PMF and also equivalent strong like GTM and marketing efforts. So I think it's extremely hard, but like whoever really put efforts towards this, I think that would be a great company.
All right. So I've been in crypto 15 years. I've seen a lot of stuff happen, and I've never seen as many VCs in the space as I have in the last few years. But I've also noticed that because there's so many VCs in the space, that's a lot of money. It's driving a lot of behavior within crypto. And so I'm seeing projects that are looking for users, data active users, developers, like wallets, active wallets, total value locked. And so they're doing this because the VCs are driving these metrics, saying we want to see this. I'm wondering, what are you guys looking at from that perspective to weed out the chaff from the wheat in this type of situation we find ourselves in?
Yeah, I can start. I think it's not different than Web 2. Like, you had eyeballs and clicks and all sorts of top line, like, whatever number of like eyeballs Facebook reports, probably it's just infeasibly for that to be human. Like, probably a third of it is real. And I think that's just like everyone accepts that the numbers are fake. It's just how the markets work today in the information age. It depends really on what stage you're. I think for Series A, B investors, you have a lot more information as to what you can. It's viable to build an information advantage if you have a bunch of Series A and B metrics for thousands of companies around the world, and you understand what the median, first quartile, and top decile is. Then it becomes really easy to spot the outliers at Series A. I think at pre-seed, it's a lot more difficult. We spend a lot of time just like meeting founders, meeting their families. Like, is this their life's work? Or, you know, if crypto prices go down 90% tomorrow, are they still going to be working on this? I don't think that it doesn't work for every successful crypto founder, but I think it works for the vast majority of them. It's just like, do they really have a deep ingrained passion for seeing what they want built in the world, rather than a token exit or, you know, some sort of like quantitative metric. So that's how we think about it. But I'd say it's not unique to Web3. I think it's just the nature of information moving really fast digitally and people creating markets around it.
I would also add to that and say that I don't necessarily think that there's too many crypto VCs right now. I think there's probably too many seed crypto VCs, maybe. But relative to Web 2, we think it's not an unhealthy number, because in Web 2, every single VC in Web 2 is investing in AI, Web 2 AI. And we're talking about thousands of firms, right? There are not thousands of firms in crypto, right? So we think that's the bloated market, is Web 2 VCs investing in AI. We think the crypto market is relatively niche, and comparatively, there aren't as many VCs. So we think this is actually an underserved asset class from a VC point of view right now. And by the way, we think the reason for that, the reason why it's underserved, is because of FTX and because of Terra. And so a lot of VC firms kind of shut down as a result of that.
Yeah, just adding a little bit, I feel like it's really important to identify what is fake metric versus like real stuff, right? Like, for example, if you're building a chain, you're raising for a TVL, like people easily got confused, like, oh, they raised like 1 billion, they have 1 billion TVL, but like, boom, you launch a token, the TVL is just farming your token, they're gone. Or you're building an application. I use Telegram bot, and I have this like 100K users register per day. But like, I feel like we are all like in this space. We have the ability to figure out what is important, what is not. So for me, like, having this giant number sometimes could be like a bearish, because it shows the fake, and, it's just not has done to build real stuff.
Yeah, I'd also say practically, like, the same advisory firms that go to founders and pitch like, hey, we'll get you 100,000 Twitter followers for like 20K. Like, they come to investors first and pitch us the same thing. So it's like, we know the prices for like the fake metrics and have a good benchmark for what it takes to just like fake it till you make it.
I'll also say that in today's world, there's a lot fewer kind of pretenders that are just here for the money compared to in the past, because of all the catastrophes that have happened in crypto that have driven founders out of the market. A lot of the founders we think are more mission driven now than they were. You look at Y Combinator Demo Day, they no longer have a crypto category for their demo day. There's too few founders that are graduating building crypto startups. So that tells you something, right? They used to have that category before all the catastrophes happened.
All right, let's end today on a fun note. I always like to end these kind of panels with one bold prediction. It could be short and sweet. 2025 bingo card has been a little crazy, you know. President launched a token, president's wife launched a token, SBF tweeted from jail. Top exchange got hacked for $1 billion. So your prediction could be anything, and people won't think it's crazy. So one bold prediction for 2025 to close out real world 2025.
Okay, not that crazy, but I think edge inferencing will like be the cloud inferencing.
We predict there will be at least one major black swan event that happens this year, which is unpredictable what the event will be, but it is predictable that there will be a black swan event based on historical patterns.
More than one, more than one.
Yep. And we think that the industry will endure and survive and thrive through it because we think that all of the legislation being passed at the White House are permanent tailwinds, not temporary for crypto. And we think that the market has not fully appreciated that yet. So we think it's actually a very, very good market going forward.
I think after the Black Swan, when it's all said and done, we'll see DePIN revenues 3 or 4x, like at least hit 109 figures, $100 million annualized. I'll say $10 million a month, a little bit higher than that, is what I think DePIN revenues will end up at. I think there are a lot of networks, both that are already listed and have tokens and will continue to grow this year. And also will launch new tokens who have been like cooking for a number of years now. One of the very credible arguments against DePIN that you can say today is just that like the number of revenues relative to the market cap is very low. I think that changes in a big way, this year. Not all the way there, but we'll at least get, an order of magnitude closer to where we need to be.
All right, guys, let's give them a hand. Thank you, guys.